Well, those are the headlines of this hour. This is the show where Team at CNBC TV 18 gets to the top stories of the day. I'm Nantara Ryan. Our big story on Reporters Diary, a CNBC TV 18 exclusive, and this could be a booster shot for FDI investments and all the foreign investors wanting to exit. We understand from sources the Reserve Bank of India, as recently as 22nd of December, has written to the Finance Ministry asking for relaxations of the put and call options. It's seeking relaxations of a circular that was issued as recently as 2014, which had mandated there could be no assured returns, and on exit, the foreign investor would be paid by the Indian investor a price which is arrived at an arm's length and is a fair value market price. Now, with respect to Tata Sons actually approaching the RBI, wanting to give Docomo an exit at a predetermined rate of 58 rupees a share, we understand from sources the RBI has concluded that even though this is not in line with extant provisions, it may be in the best interest to allow this proposal to go through. Sources saying what the RBI has written to the Finance Ministry is that the larger issue here is of a fair commitment in the contracts in relation to an investment and a downside protection of an investment rather than an assured return. We also understand from our sources the Reserve Bank has also brought up the issue of Japan being a strategic partner for India when we talk about FDI inflows. PwC, hired by Tata, had actually put the fair price value at 23 rupees a share, which is of course lower than the 58 rupees a share determined by Tata's and Docomo while signing their contract. Vivek Gupta of BMR Advisors now joining us to understand this. Hi Vivek, this is Nantara. Thanks for joining us here on CNBC TV 18. If you've been hearing, what we understand is that the RBI is seeking to relax the put and call options, saying that going forward, not just for Tata Docomo, but there could be a new principle which is reached where, a prior commitment, a fair commitment should be the larger issue than an assured return, that a downside protection is more important than an assured return. Your initial thoughts?
So if what you're saying is true, I think it will be a big move. Up until now, the way RBI and the way FDI is that they have not permitted any sort of downside protection or assured return on the ground that the investment then behaves more like debt and less like equity, and therefore then it should be treated like an external commercial borrowing. What that has meant is that a lot of private equity investment, which would normally otherwise come as hybrid capital, which is downside protected capital, has had to behave like free fair market value equity, and therefore that has impacted investment flows in the country. If RBI starts recognizing the fact that contractual commitments can be made by promoters to afford downside protection to foreign investors, I think that will certainly open up one more large door of hybrid capital to flow into the country. So I must, of course, put this in context by saying that I myself have no information of this, and I'm only reacting to what I just heard from you.
Yeah, fair enough, Vivek. So basically and it's something that we have been discussing for a while now, how the market regulator as well as the central bank was not in favor of what you just also spoke about, debt disguised as equity. That was the whole problem, and why we had seen a series of these circulars coming out from the various regulators as well. So now if they actually agree and favor downside protection, agree to favor commitments that have been made, fair commitments that have been made in contracts, you've spoken about inflow of capital, which are these hybrid forms. What about exits? We've seen a lot of companies, a lot of investments that have been stuck in India. Do you think that this could open up the doors when we talk about exits, which is also very important?
See, interestingly, what has happened in a large number of private equity deals is that these kind of clauses were written into the contracts. However, Indian promoters really have not been following the contract fully, or have not been able to follow the contract fully because of the RBI guidelines. If RBI puts out principles, and these principles must generally apply, your comments in Japan notwithstanding.
Vivek, sorry to interrupt you there. The reason I'm interrupting you is that even if the RBI is off this view and writes to the Finance Ministry, aren't there a lot of such cases which are stuck in several high courts, and where we've seen arbitration also being invoked in many cases? What happens to all of those cases?
So it'll be interesting to see what kind of principles RBI lays out. I know myself of a large number of promoter and private equity houses locked in battle on this minimum exit price, on this floor price protection issue. And basically, the defense that promoters have been taking in such a scenario is that the government and RBI's law does not allow them to pay the minimum floor price, and therefore they cannot be forced to pay the minimum floor price. If RBI relaxes this, recognizing past contractual commitments, then certainly all those arbitrations and court cases that are pending, the case for the private equity houses or the foreign investors will become stronger, and the promoters may then be forced to give up this defense that the RBI law does not allow it. But I think we are running a little bit ahead of ourselves. Let's first see what view the government, the Ministry of Finance, takes on this. There is a big conceptual debate on whether we should have only equity and only debt and not have hybrid forms of capital. So that big conceptual debate will have to be cleared up by the Ministry of Finance before they permit RBI to go ahead with this.
Okay, Vivek, unfortunately, we're completely out of time. We look forward to having you back prime time at 8 p.m. and 9 p.m. on CNBC TV 18 as Vivek Gupta, BMR advisors, of the view that if the Reserve Bank does indeed allow promoters to provide foreign investors exit at predetermined rate, it could open up the floodgates for FDI. On that note, we have to step into a short break. Haven't taken one for a long time. Stay tuned.
CNBC TV 18, celebrating 15 years of leadership.